and welcome to the Digital Finance Seminar Series. This is the first talk of the spring semester, and we have really the pleasure and the honor of having with us Professor Darrell Duffy from the Stanford Graduate School of Business. I don't think Darrell really needs much of an introduction. I think everybody in the profession knows him extremely well. He's probably regarded as one of the best, if not the best, financial economist of his generation. And he's the Dean Witter Professor of Business at Stanford. And he has made a number of important contributions in several different areas of finance, inspiring a lot of generations in terms of research, presentations, like he had a big impact on policy as well. He's currently visiting the New York Fed. And without further say, otherwise I would have to speak for a very long time. I would like to leave the floor to Darrell. And thanks again, Darrell, for giving a talk here.
Agostino, thank you so much for inviting me. I feel like I'm at home because I know about half the people in the room. This is delightful. I hope we'll have a fun hour together. Just to lower expectations, I'm not presenting a research paper. I'm going to talk about digital currency policy. So it's very kind of light and easy, based on many conversations I've been having with central banks around the world and with government officials in Washington. As many of you may know, President Biden last year asked the U.S. government, all relevant departments, to report back on what the United States should do about its digital currency policy. It was the executive order on digital assets. So there are other aspects of that, like what to do about regulating cryptocurrency exchanges and so on. But I'm going to focus today on digital currency policy, because that's the part of it that interests me the most. And that we should keep this interactive. We've got an hour. Let's spend the time usefully. I've got a number of slides. We don't have to get through all of them, but not too many. Okay, so as I said, light and easy. I'm going to start with Alice and Bob. And if those of you that read the fintech literature know it's always Alice and Bob that are working out some way to do something. And in this case, Alice needs to buy a loaf of bread from Bob the baker. Now, when I wrote this slide, I thought $8, that's pretty expensive, but I actually bought a loaf today down at Bread's Bakery for $11. Question is, how is Alice going to pay Bob? And that's really what we're about today. I'm going to focus on a general payment system. I'm not doing wholesale very much. It could be you paying your taxes. It could be you're making your car payments. It could be one business is paying another. It could be a cross-border payment. But this is not a restricted form of payment system like currency settlement system or a wholesale security settlement system. So since about the first decade of the 1500s, this is the way that Alice has been paying Bob, at least increasingly often and now predominantly around the world. It's called a bank-railed payment system. In the 1500s, it was done first at the Banco del Giro, which Giro, for those of you that do cycling, like Kent and me, you know that's the circuit. And this is the circuit of Alice paying Bob that was developed at the time. So the way it happens is Alice sends a message to her bank saying, take $8 out of my account, meaning you owe me $8 less now, and send a message over to Bob's bank telling them that you're going to credit their bank with an $8 payment, meaning Bob's bank now owes Alice's bank $8 less. And Bob will then get a message saying Alice has sent or is sending the money, and then Bob will give Alice the bread. Now, in the 1500s, they probably didn't wait for the message because it might have taken a few weeks. But in today's bank rail payment system, most often, as you know, when you tap your card or dip your phone or whatever you're doing, Bob gets the message right away. You might not get the money right away. It's not necessarily a fast payment system, which is a term of art, meaning the money is there as soon as Alice taps her device. it's increasingly the case in the United States that we're going to be using fast payment systems, and I'm going to come back to that later. But I want to differentiate this bank-railed payment system from other new forms of digital payment systems that are coming into place, and also some updates of the bank-rail payment system. Currently, this system, as I said, covers the vast majority of payments in dollar form. The only significant competitor at the retail level is paper money. Almost everything else goes this way. One of the proposals that was asked to be considered in President Biden's executive order and is now being considered by the majority of central banks around the world is a new form of payment system called a central bank digital currency. And there are many forms that it might take, but I'm going to give you the one that most central banks are now exploring. And that's, as illustrated, Alice again sends a message to her payment service provider, which might be a bank or it could be a fintech firm. And that payment service provider, which organizes her information and her apps and so on, her data, will send a message to the central bank, which in the United States would be the Fed, telling the Fed, deduct $8 from Alice's account at the Fed and credit Bob's account at the Fed for $8. Now, it sounds pretty simple. The only difference with the other one, between this one and the other one, is there's no circuit. There's only one bank involved. There are other forms that a central bank digital currency payment might take, but they ultimately, in terms of the economics, all come down to this. The other forms that are often being considered are based on digital ledger technology, so-called tokenized money, and so on. But really, other than some of the software, that's captured within this framework. And this is the way, the interceding of payment service providers is the way that most central banks are going to do this. You're not going to go down to the Fed and knock on 33 Liberty Street door and say, could I open an account? You're going to ask the payment service provider to do that for you. And they will manage your account for you. My prediction is that the United States will be one of the last countries, or last major countries, to adopt a central bank digital currency. And so that's for a wide range of reasons, mostly because from a policy viewpoint, it's extremely difficult. And from a technology viewpoint, while there are no technological hurdles that cannot be surmounted, it's an extremely complex technology problem. And I think other countries are moving faster. Christine Lagarde at the European Central Bank is going full speed on getting a digital euro. China has already introduced a digital renminbi. It's called ECNY, although the take-up in China is not that strong. After around a year, with tens of millions of consumers that have been piloted into this, the total amount of transactions is still on the order of 100 billion US dollars, which is less than's done in a day on the popular mobile payment apps in China, which are WeChat Pay and Alipay. So whether the system in China takes off or not, it remains to be seen. But it's a certain matter of prestige and technology leadership that China has done this, and I think that's what triggered the United States government into thinking we might want to do it too. And I think actually most of the central bankers that I've talked about this with around the world all seem to be motivated in part in their exploration of this by FOMO, fear of missing out. Maybe somebody else will come up with something good, and if we don't get the technology, we'll be left behind. The United States hasn't succumbed to FOMO yet, although there's a lot of debate in this country about this approach to making payments. The key distinction, I would say, between the design that's adopted in China and the one that is being considered in most places around the world is who keeps the data? Who has the information about your payments? In China, the payment service providers have Alice's information, or PSPA has Alice's, PSPB has Bob's, and the Central Bank of China has everybody's, other than very low sized payments, like under $10 if you get a mobile phone that's doesn't require, it's not $10 literally, but very, very small amounts don't have to be recorded, but most transactions are being recorded at the central bank. And U.S. policymakers have pretty strongly indicated they don't like a system in which all the data is kept centrally, and I think they've probably gauged American opinions correctly on that.
Daryl, just a question, just to better understand this. So right now, there's more of a distributed system, right? Both the compute power, the storage, everything, and the idea is basically now to pool all of this and plug it at the central bank. And what happens to all the resources that currently exist in the system?
Well, that remains to be seen. It could be that all the technology that's available for making bankroll payments, which is most of the technology, will become dormant and disappear if the CBDC takes off. My guess is the CBDC will not take off within a quarter century. So in the meantime, there's plenty of time to think about that, I think. Yeah, a question.
Adding a little bit to his question. So right now, the financial infrastructure is that I give my money to the bank and they lend it to someone else. If my money is stored in central bank, will that destroy the competition in lending or?
Terrific question. And Kairong Xia, where are you, Kairong? That's the central question of his paper with Tony Whitehead and your third author, Yifeng. And we're going to talk about that in a few minutes. But it's a key issue. And I think as you read Kairong's paper, I think you're going to get the correct impression that some people have overemphasized that as a serious problem. Or at least in my view, it's been overemphasized as a serious problem. I want to talk about yet another technology for making payments, which are private stablecoins. And these are digital currencies that are not issued by a traditional bank, not issued by a central bank. They can be issued, well, they could be issued by a central bank or a commercial bank, but most of the private stablecoin digital currencies that exist today have been issued by private firms. And you've probably heard about some of them that have blown up, like Terra, because they weren't well resourced. And there was a run on the value of Terra. However, they could be well resourced. There's a large provider of digital currencies in the United States has issued USDC, which is pretty well-backed private stablecoin that's being used almost entirely as a medium of exchange between cryptocurrencies. So if you want to trade Bitcoin for Stellar, well, you might end up making a transaction into USDC to store your cash at the exchange, and then use that cash in the form of USDC to buy the other digital currency. Stablecoins have not come into the so-called real economy, that is, they're used almost entirely in cryptocurrency space so far, but they are being promoted as a better way to make ordinary payments in the real economy. The first use case, most likely to achieve some kind of liftoff, would be cross-border payments. Because right now, cross-border payments is one of the serious pain points. It's extremely costly to make cross-border payments, and stablecoins could simplify that dramatically. Just yesterday, the Federal Reserve denied an account that is a master account at the Federal Reserve for a fintech bank that had proposed to do that business plan. That bank is called Custodia, and there's ongoing litigation between that bank and the Fed about getting a master account that would enable Custodia to provide stablecoin cross-border payment services. And it's easier to do it if you have an account at the Fed.
Some big question. You mentioned that the link with the real economy is still weak, although there is some link if you think about the collateral that is backing some of the stablecoins.
Yeah. So Agostino's point is, even though the stablecoins are not being used as payment devices or as payment media, they're nevertheless backed by ones that are backed are backed by real assets like commercial paper. And it's been noted that a large fraction of outstanding commercial paper was issued in order to put the backing. If you look on the right-hand side of this diagram, there are assets backing the stable coins. At the end of 2021, the Treasury Department of the United States issued a report saying that the United States should introduce legislation that would limit the providers of stablecoins to being insured depository institutions, basically banks. A governor of the Federal Reserve said, this is Chris Waller, how does that help if you're trying to create competition for bank rail payments if only banks are allowed to issue stablecoins? Because banks might not compete with themselves. You know, if I were Jamie Dimon or the head of one of the large US banks, I probably wouldn't say, let's provide cheaper, more interoperable payments through a stablecoin and not be pushing so much our Visa franchise. Well, Visa is a lot more profitable. Now, maybe Jamie Dimon wouldn't think that way. Maybe he would say, we want to be first in this new payment area. And in fact, JP Morgan has, at various points in time, proposed that it would have a stablecoin called JPM coin, but it still hasn't issued it. I want to come back to bank rail payments because I think there's a lot of value in bank rail payments that has not been fully exploited. And that's by virtue of what are called fast payment systems. In some countries, they're called instant payment systems. And what are the defining criteria for a fast payment system? It's that it's open all the time, as opposed to what you're currently using. Right now, when you think you're making a payment in the evening, you're not. You've sent a message saying, please make the payment, but the payment won't actually get made until tomorrow or perhaps the day after or the day after that. And moreover, the person that's supposed to get the payment may not have access to it. You may be getting a message saying, your account has been sent $8, but you can't actually spend that money for another few days until we are verified that we're happy to have you do that. But fast payment systems, it's real-time gross settlement, meaning instant access to the money, open all the time. Now, there are some disadvantages to that, but I would say by and large, it's a pretty good idea. One of the disadvantages for those of you that do finance is that you have to preload all of your payment needs with money before you start paying, because the money will come right out of your account as soon as you hit the button. So if you are, let's say, a large financial institution that's making a lot of payments every day, then you need to start the morning with most of the money that you need to pay that day, as opposed to the current system in which you can commit to making a lot of payments today, and then you can wait until some of the incoming payments have been made to you, and then make the outgoing payments later in a batch netting arrangement. So there are some disadvantages, but by and large, this is a very effective way to manage payments cheaply and efficiently. And many countries, I've listed only a subset, have adopted them. I want to focus on two countries only, the last two. In the United States, the large banks put up a fast payment system a few years ago called RTP, real-time payments, and it's still growing. Last quarter, it did 45 million payments. It's actually not a very large number, but it's growing. And the Fed has been dissatisfied that RTP is being provided in a sufficiently open way because maybe the Fed has in mind, they haven't said this specifically, that there's not enough competition if it's a system that's provided by the large banks. So the Fed is going to introduce its own fast payment system called FedNow this year, maybe. So the FedNow system will be available to all US financial institutions instead of the small subset that are using RTP, and it will have additional features. The providers of RTP, which is a large bank consortium, have complained very bitterly about the Federal Reserve, quote unquote, competing with RTP, but I think they're just going to have to lump it. The other country I want to focus on for a little bit longer is Brazil, because they've taken their fast payment system and they've done an overlay on it called PIX that really makes for a highly efficient, open, interoperable payment system for Alice and Bob. And I want to walk through, I'll skip that. I'll get to that in a minute, but first I want to tell you a little bit about the payment stack of revenues for the US or North America, which includes Canada, my country, and the rest of the world. And this payment stack means what fraction of dollars spent on payments go to each type of revenue collector. So in the US, I'm colorblind, but the bottom left color is what? Mustard. Okay. Mustard is credit cards in the US, and it's about a third of the whole US payment stack. That's retail credit cards. That's a very, very lucrative franchise for US providers of payment services. And you can see the entire consumer stack in the US is heavier than the consumer stack in the rest of the world. And that's largely because of the credit card part. In the rest of the world, credit cards are about half as big, and in Europe, they're much smaller yet. They're about 11 or 12% because the interchange fees on credit cards are restricted in Europe to a small number. Let me explain what an interchange fee is. Remember Alice and Bob? And the bread cost $8? Well, actually, of the $8, Bob is only going to see perhaps $8 less, maybe 20 to 25 cents. That's comes out of his share and goes to the credit card providers. And that is called an interchange fee. As far as Alice is concerned, looks good, right? He didn't have to pay anything. Bob paid it all. But you remember, when Bob prices the bread, he's thinking, well, I'm going to lose 25 cents or 20 cents, so I better increase the price of the bread. So implicitly, Alice is paying it. And moreover, most of that money is coming back to Alice in the form of a reward. So Alice takes out her credit card. Actually, I think I have one in my pocket. And she can either use her credit card, or maybe in a few years, she'll be able to use a CBDC or a stablecoin. And maybe they're both loaded on her phone. Where's my phone? So they're both loaded on her phone, and she can either tap one app or the other app. But if she taps the app with the card behind it, she gets a 3% reward. And if she doesn't tap with the credit card behind it, she doesn't get a 3% reward. And if it's the same tap, she'll probably use the credit card one. So those interchange fees are actually pretty important in terms of limiting competition, because how could you possibly compete with that unless you could offer Alice a big reward? So there's a regulatory aspect to this associated with caps on interchange fees. And I want to show you a diagram from the new dissertation of Lulu Wang, who I think applied for a job here.
He was here last week.
He was here last week. So those of you that went to his seminar, you've seen this slide. This is just one small, tiny slice of his job market paper, but I used it to show how insensitive Americans are to these interchange fees. So on the left-hand side, you can see what the merchants are paying as a fraction of their revenues in interchange fees before 2011 and after 2011. You notice there's a drop in the interchange fee on debit cards, and that was an act of Congress called the Durbin Amendment that forced that number down. The card providers increased the interchange fees on other cards. Well, why did they do that? You would think maybe they would lower those so that they could compete harder with debit cards. But no, if you increase the fees that Bob pays to take a credit card payment, then you have more money to pay Alice a reward. Everybody got that? And that means Alice, who's now maybe going to get a good deal on a debit card if some merchants say, please use a debit card, we'll give you a good deal. She's going to say, no, I really like my credit card because now I get an even higher reward than I did before. And if on the right-hand side, you can see that the fraction of merchants that accepted credit cards didn't change. So nothing, counterintuitively, if you haven't read Lulu Wang's paper, competition in this market doesn't work. Meaning, if you come in and what was your name again, sorry? Clara comes in with a new fintech technology that's fantastic, and she says, come and use my technology, and she markets it hard, and the banks say, oh, competition. You think they're going to lower their fees because of competition? No, they should raise their fees because then they can give Alice a bigger reward as a barrier to entry for Clara's payment device. Yeah.
So if you go to a typical New York City bodega these days, they'll usually slap on about a 4% charge if you pay by credit card versus the historical model of paying by cash. So why shouldn't that be the equilibrium?
You might think that, but you got to read Lulu's paper because he shows that by the way, it was once illegal in the US to discriminate. Now it's legal, but it's almost never done. And you might think, well, gosh, the debit cards only rake off, a small fraction of what credit cards are raking off. Then everybody would say that. But no, because the merchants are very sensitive to Alice saying, what? You're going to charge me a premium for using my credit card? I think I'll go to the store down the street. And so it doesn't work in practice. Now, you may have found the right bodega where it does work, but you probably notice that most places you don't get a special deal if you're using a debit card or a paper money. Okay, now I want to talk about PIX because I think PIX could make a difference in this regard. It might still require regulating interchange fees, but it does allow a very open playing field for competition in payments. And here's what PIX is. PIX is an overlay on the fast payment system in Brazil. Alice is going to pay Bob. Alice can initiate her payment not necessarily through a bank. She can initiate it through any payment service provider. It could be PayPal. It could be whatever Brazilian payment service providers there are, and there are quite a few. They're all accepted in PIX. The request to pay goes into the fast payment system, but there's an overlay called PIX that makes it the app on Alice's phone, the same app that everybody in Brazil is now using. Within 2 years, essentially every adult person in Brazil is using PIX. And almost all merchants are accepting PIX. So that means, and also PIX has this alias database where Alice can put in Bob's alias and just say tap, pay, Bob, $8. Bingo, it's done. This system is so accessible because the government has required every bank and every payment service provider with more than a few thousand customers to provide this app to all of their customers in a same look and feel app across the economy. So now everybody says, oh, I'm going to get this app from my bank or other payment service provider. It looks the same as everybody other's app. Everybody is familiar with it. And whether you go to the beach in Rio de Janeiro or you go to the drugstore in Sao Paulo, you just have the same experience and everybody knows what PIX is and there's no checking, do you take this, do you take that? It's cheap too. I think I might have the cost of using it in my head. It's $0.0003 per dollar. Very, very cheap to use. Yeah, Philip.
It's not cheap to use, but a Visa card also has that property. Everywhere you go, it's the same.
That's true. However, Visa cards are not very efficient in terms of the economics. Yeah, I mean, from Alice's point of view, it works great. You just tap it, away you go. Everybody knows what a Visa card is. Right, but it causes problems in terms of the distortions that I described earlier. Yeah. Plus, Bob doesn't get his money. Not only does he not get all of it, he doesn't get it very fast. This gives the money to Bob instantly. Okay, it's not an accident that across all payment service, all fast payment systems, the rate of adoption of PIX has been much, much higher. Why? Because all the banks are required to provide it and everybody gets to use it on the same common app. And so it's instantly taken over Brazil. President Biden is very concerned in his executive order about financial inclusion because there are millions of Americans, between 7 and 8% of Americans that don't have bank services. They're not banked. And President Biden is very concerned that financial inclusion be increased, and that's why one of the reasons why he's exploring a CBDC or other improvements in payment systems. In Brazil, 5 million households that had not been banked became banked because of PIX, because they wanted to get on this app that everybody was using. And 1 second, 5 million additional households who already had a bank account but were just using it to get paper money out of the ATM machine started to make digital payments. So the digital financial inclusion has gone up markedly in Brazil because of this. India has done something related to this. We have a few questions. Yeah, Philip?
What if you don't have a cell phone?
Then you're in trouble. You have to use something else. Paper money, which is, as I said, a lot of Brazilians before PIX were just using paper money. They'd go to the ATM machine and draw out paper money. Another question.
I guess like the example of PIX, you talked a lot about how it's like government mandated, so you feel like a lot of change towards like integration of fast payment systems has to be from a government central level, because like allowing banks to integrate, or do you see that there is room for like industry players to build the technology that can take space here?
Well, I think it may depend, but remember that some of these effects that we're describing are called network externalities. And sometimes you need a little bit of a nudge to get a network scale effect. So maybe if we're already the case, like in China, that everyone was using Alipay and WeChat Pay, then you already have scale, and those are private systems. Maybe you don't need the government to interfere. However, remember what I said about the barriers to entry in the United States. It's very difficult to compete the way that the industrial organization of US payment markets works in this country. So maybe you do need a nudge, like requiring that banks provide a fast payment system like FedNow, which is coming anyway, in a highly interoperable way. Let me tell you what my understanding of how FedNow is being provided, and I'm getting this simply from reading their website. They don't say that this is their policy, but if you look at their website, it's pretty clear that it's marketing to the banks and saying, hey banks, if you want to provide fast payment services to your customers in the manner that you would like to provide them, here are some of the things that you might be able to do. And then the banks can say, well, okay, I could provide Amazon with payroll services using FedNow. Or I could provide the big car companies with a way to collect their car payments using a different app that I could provide using FedNow, and so on. And you can pretty much believe that when one large bank provides it one way, they're not going to say, well, we might as well make it so that everybody can, any of our customers can use anybody else's apps. I don't think that would not be probably a profit maximizing decision to make it, to take the walled gardens and lower the walls so that instead of getting cross-selling services and keeping our customers close, they could go wherever they want. And so PIX actually breaks down some of the walls, and you can see what, as a result, what happens. Once you have a fast payment system, adding this overlay is not expensive. In Brazil, it costs $25 million for the country to add PIX. So it's not a big deal. Building FedNow or building the underlying fast payment system, the rails, very expensive. But getting this overlay is not expensive. Merchant costs for cards versus PIX. Well, what happened in Brazil? You can see EU has very low merchant costs for using cards. And that's because interchange fees are capped. US is high. Brazil is also high. And interestingly, card usage hasn't really changed in Brazil. credit card payment volumes are about the same as they were. So Alice is still getting her rewards the same way she got them. What's happening in Brazil is a whole lot more volume of payments are being made in total. And all the additional volume is going into PIX. The merchant cost for using PIX is very low. That's not the cost that's charged by the Central Bank of Brazil, which is the provider. That's the cost that banks that are providing merchants with payments from PIX charge the merchants. So they're charging way more than the 0.0003 that I mentioned earlier, but it's still quite small relative to cards.
Daryl, do you know how the prices are evolving for using PIX versus using credit, the retail prices in Brazil?
Well, you can't, I mean, you could price
Per
discriminate,
rules.
but I don't think when you go into, I mean, this is the question, I think that,
Yeah.
I think it's the same.
It
But
is.
there's a lot of new things that are being sold with digital payments that weren't. Like I was told, now on the beach, literally in Rio, where all the vendors are selling, sandwiches and drinks and balloons and whatever, it's all done on both the buyer and the seller, Alice and Bob, are using their cell phones and doing it all on PIX. So there's a lot of new payment services that are being provided this way. It's very cheap to get onto PIX as a merchant. This is the issue that, this is related to the issue that one of you asked a little while ago about what is this all going to do to banks, traditional banking. And let me launch, I'm going to check the time too, because how are we doing for time in terms of?
About 25 minutes.
20 minutes? 20 minutes left? 20 minutes. Yeah, good. Okay, we'll be all right.
Digital clock right there, it's digital.
Oh yeah, look at that. I was looking for a dial. Okay, so this is an issue of policy interest to me as well, and I'll explain why. This is September 19th. I should update this slide because the Fed funds rate is now, anybody remember? 4.75? It's way up there. The blue bar is way higher now, and it's been growing lately, for those of you keeping score. That's the interest rate in the interbank market. It's the rate at which banks lend to each other for overnight in the interbank. So it's a deposit interest rate, but you have to be a bank to get it. If you're a customer of a bank, well, you get those smaller amounts of interest in the little red bars on the right. And why is that? Well, because banks can somehow convince you all to keep your money in your deposit accounts with very, very little interest. And you might say, well, now that the blue bar has gone up to 4.75, probably those red bars have also gone up quite a bit. No. They haven't hardly moved at all. And the evidence always shows that when the blue bar goes, moving up fast, the red bars hardly move. But if the red bars eventually get up and the blue bar goes down, the red bars immediately go down. That's some research by Driscoll and Judd. There's also some work by Alexei Savov, Philip Schnabel, and Itamar Drexler, I think are the three authors of the paper, that have shown this kind of very sticky behavior of deposit interest rates.
Daryl, doesn't it depend on how much money the banks are sitting on? Like if they're sitting on a lot of money, then they have no incentive whatsoever to increase those rates?
Well, I went into my bank when the Fed got to that level, and I said, hey, and it was the day after the Fed had raised by 75 basis points. I said, the Fed just raised. Are you going to, I literally asked the guy the teller at the bank, are you going to raise the interest rate you're paying me? And he said, it's funny you should ask. We had a meeting yesterday because it's Stanford Federal Credit Union. They could do it all in one place. We had a meeting about that yesterday, and we decided not to.
Question.
And what was I going to do? I could take my money out and go to another bank and open an account, but I didn't. And most of us don't. So it's very, the fact that there are many thousands of depository institutions in the US doesn't mean that there's a lot of competition. There's very low competition, mostly because we are lazy consumers.
How much of that is also a legal fragmentation problem in the US? Because as somebody who's lived both in the bank world and asset management, if I could pay for things with a money market fund share, we'd be done here and I'd collect all the interest, but I can't legally do that.
Yeah, so part of it is that, and part of it is the payment system that we have, which makes it actually not that easy. I don't know if you tried to move money from your account into your cousin's account as a birthday gift, it's actually quite a lot of work. You know, so it's not set up to make easy payments that bear interest. Now, you might think, well, big corporations, they get really good interest because they're big corporations. No. Corporate open deposits, meaning transaction account deposits, get very, very low interest too. And that's just basically the way the US banking system is wired up in terms of its industrial organization. The economics of it is not very good.
So you got the way saying consumers are lazy and they're not going to move their account. What about the treasurer of GM?
I don't know how that persists.
He's also lazy, he should be fired?
Maybe. I don't know, but look into it. Gore, you'd be a good person to check out why is it that large corporations, now they get good money on their savings accounts, but on their transactional deposits, if they're open, meaning every day they can use them any old day, and they keep a lot of money in those accounts, they don't get hardly any interest. So this is an issue of deposits, depositors and banks and borrowers lining up well. And now we're getting back to your question. What does this all mean? If we were to improve the efficiency of the US payment system with a CBDC or with stablecoins or with an open version of FedNow like PIX, what would that do to this? It would cause maybe the red bars to go up because now you could go swish, swish, and your money is gone. You wouldn't have to think about how lazy you are. It doesn't take very much effort to go swish, swish on your mobile phone. And then maybe the banks would say, oh gosh, you know what? It's nice to pay these low rates, but we're losing deposits fast. We better raise the red bars. And now the research that Kairong and others have done is addressing, well, what will that do to the banking system? The Bank Policy Institute, which is a policy research organization funded by the banks, has said this would be a disaster for US lending for not very well-argued reasons. However, Kairong has actually done the research, and there's also another good paper that I would recommend in addition to Kairong's paper by Davadol Hosseini and co-authors at the Bank of Canada, and you know the paper well, that have examined this with both papers with very good, careful, calibrated models. Not entirely the same results, but I would say in line with my view that this would not be a disaster for lending. The Bank of Canada result says you could even get, plausibly, an increase in lending by banks. Why would that be? Well, if you have to pay more on the red bars to keep your cheap deposits, depositors are gonna, some put more money in the banks, and then the banks are gonna have access to more funding, and then there's a general equilibrium effect that takes hold and ends up in the sort of base scenario, more lending. In Kairong's paper, I don't want to front run the story of your paper, but basically there are two possibilities. One is if you're a large bank and you have access to wholesale financial markets, then basically your outside option to getting deposit funding is to go to the blue bar and get wholesale funding. And you're not gonna end up making loans. You're not gonna end up making any fewer loans because basically your marginal source of funding is the blue bar, and your decision to make a loan to Philip is made based on the marginal cost of funding being the blue bar. And if the red bars go up, it means you're less profitable, but you're not gonna make fewer loans because you're still comparing to the blue bar when you decide to lend Philip money or not. In Kairong's paper, if you're a small bank and there are costs for accessing wholesale markets, then yeah, your lending may go down. And I think it was, I have the table coming up, but it's in the appendix. I think it was like 6% or 8%, is that about right? Something like that. So a reduction in lending by small banks, which is consistent. And now I'm gonna skip over a few slides because I wanna get to cross-border payments and then finish. So I'm not gonna talk about this anymore. And I'm going to quickly finish on the issue of cross-border payments. So this is where Alice is in one country. She's customer 1 of Bank 1. And Bob is in another country. He's customer 2 of Bank 6. And the question now is, by what means will Alice get to pay Bob? And remember, there are 2 different currencies that are involved here, unless the US takes over the world in terms of its currency. And correspondent banking basically means Alice's bank sends a message to Bank 3 saying, find a bank in Bob's country, it might be France, that accepts dollars, convert those, and ask that bank to convert it to euros, and then pass it along to Bob's bank. That's correspondent banking in a nutshell. The alternative could be to link up the 2 payment systems, the 2 fast payment systems for each country. So the European Banking Association has developed a fast payment system. The United States has developed a fast payment system. You could just hook them up. And then since both Alice's bank and Bob's bank are on the fast payment system, it would be a one-shot deal with some sort of algorithmic foreign exchange market where some dealers in the foreign exchange market would be offering bid offers on euros and dollars for the purpose of the interlocking fast payment systems. I think this is a very promising approach to making cross-border payments. I think it'll take over in many countries soon. I know it's being explored right now, as I said, in US and Europe. Singapore and Thailand have already piloted it. I think in the end, that bank rail cross-border payments will continue to be the norm and probably will stay ahead of stablecoins and CBDC exchanges. Here's a diagram, not to try to sort it out for how to do a CBDC cross-border payment. It's really complicated. And this is from a paper put out by the Bank of Thailand called Project Ithanon. I think it's unnecessarily complicated and you could just link up payment systems directly. The US government is nevertheless concerned about technological innovations like digital currencies and alternative payment platforms, in part because of geopolitical concerns. That if there are alternative ways for sending money around the world that are not restricted by use of the banking system, monitoring for money laundering, and countering the financing of terrorism, then those alternative approaches could be circumvented. They could allow a circumvention of US sanctions. They could potentially also allow money laundering more easily. So the banking system is currently responsible for managing money laundering, and the Treasury Department, I think, is concerned that they won't have anybody to do that for them if alternative payment systems start to take hold. So I'm going to finish on this slide, because this is a policy talk. I'm going to give you a list of what I would, if I were a policymaker of the day, what I would be thinking of doing. I don't think I would look much further than a bank rail payment system. I think banks are actually capable of doing most of what's needed. So this is a positive for banking. However, they could do it better if there were a more open, interoperable, and competitive bank rail payment system, and I think this is where regulation can help. One of the ways to do that is to use fast payment systems and regulations. That doesn't mean that you should shut out technology. I know many of you are interested in new technology. Why not allow technology to try other technology? I mean, there's a lot of technology in banking, but then there's stable coins. There are new types of fintech banks, like I mentioned one of them, that wants to use stable coins. Of course, they're all going to be subjected to regulatory standards, and that's being worked out right now. Congress still hasn't decided exactly what to do about regulation of alternative payment systems. Stablecoins remain kind of a gray area of US regulation. Continue to develop CBDC technology, because you want to be there in case it turns out to be important. and it may have applications that will eventually be very useful. Could be retail, or it could also be wholesale. So support wholesale CBDC development. That's another way to do potentially faster, cheaper wholesale financial transactions. That's a whole other topic for another seminar, but it's an interesting application of smart contracting for those of you that are aware of what's possible with digital ledger technologies and smart contracting. And then from a policy viewpoint, the last thing that I would be concerned about is dollar dominance, or could be a dominance of a different currency like the renminbi. Watch out for the risks and benefits. So the United States has its government has a bit of a conflict of interest. On the one hand, the United States wants the dollar to remain the dominant global currency, sometimes called reserve currency, but that refers to one aspect of it, which is most central banks prefer the US dollar as a way to store their foreign exchange reserves. But dollar dominance means a lot more than that. It means if you're issuing bonds into the global market, you're almost always going to pick dollar bonds. If you are investing in a safe haven security, it's probably going to be US Treasuries. If you're making a foreign exchange payment, let's say between New Zealand and Denmark, you're probably going to sell the New Zealand dollar for US dollars and then use the US dollars to buy the Danish kroner because it's cheaper. The US dollar is a hub currency in foreign exchange markets. It's a go-to currency for almost everything, for invoicing. The dollar is still the dominant currency, and that makes a difference. So dollar dominance is helpful to the United States. It lowers the cost to US taxpayers of funding the US debt, and lowers the cost to corporations and households for obtaining their financing, because everybody wants dollar-denominated fixed income securities. On the other hand, if a US dollar stablecoin started to dominate foreign monetary systems, then that would be potentially problematic for small open economies, especially small open economies that don't already have a very good payment system. I was in Argentina a few weeks ago, wonderful hiking trip in Patagonia, and I noticed that almost everybody is paying everybody either with a suitcase full of pesos or with US dollars. And you get much better deals if you have US dollars, paper dollars. If you imagine, those are for person-to-person transactions. Being able to make transactions at a distance with a digital stablecoin dollar would be a very powerful technology and could dollarize an economies like Argentina's economy. Or many other economies that don't have a large currency system. And that is a risk that I think US policymakers want to think about in terms of, do they really want to do that to some countries? It wouldn't be a very popular move. But some US policymakers are very happy that the US dollar is dominant, and I'm not sure where that's all going to lead. That's all I have for today. Thank you very much. Any questions? Yes, Chiron.
So you mentioned these implications for transactions in the goods and services market. So how do we think about the implication of CBDC for example, transactions in the financial market? Because we think about it, there was issues that arise during financial crisis when people want to buy treasuries, there's failed to deliver, all kinds of issues arise. And it's very hard to imagine why it's so hard in some time to transact, and there's a lot of plumbing going on. So what's your view on this?
Okay, so there's a huge trade-off, and it's a very interesting one. So here's the, let me put it in a nutshell. It's said in the financial industry that nothing good happens between the time of a trade and the time of its settlement. And what do they mean by that? They mean that maybe your counterparty will not pay you, or maybe the securities that you were supposed to receive in that transaction won't arrive. And wouldn't it be much better if you could use smart contracting to do it just like that. So as soon as I hit my button saying, I agree to your offer to sell me treasuries at the current on the run at a yield of 4.2%, the deal is not only consummated, the settlement is done. It's done because in a smart contract, my cash, which is in a stablecoin form or a digital form, has a line item in the software for my cash saying this cash belongs to Chiron as soon as he hits the button on his app saying these treasury securities belong to Daryl when he hits his button. So immediately you don't need an intermediary like Khalil to hold my cash while waiting for your treasuries. You don't need me to hope that you're going to give me the treasuries when I send you the cash. It's all done instantly. Doesn't that sound great? What's the trade-off? The trade-off is if we are going to hit the button when we negotiate the deal, I have to have the cash already preloaded in my account. And likewise, you have to have the treasuries already preloaded in your account. Normally, the way that this is done in the financial industry, I have a day to arrange to get the cash, and I don't know how much I'm going to need based on all the buying and selling I'm doing today, but tomorrow morning I'll know, and I'll just make sure that I have that much net in my account tomorrow, and I've got a day to arrange it. If I have to preload every transaction, it means I'm going to have on average, a huge amount more cash. And this is a problem that's subject to OR-type analysis, because you've got a network, you've got all the buys and sells in different securities, and you can actually calculate how much additional cash it will take to run the system, and how much additional treasury securities have to be available in inventories in order to run the system. It's going to be a lot more. It's a pretty interesting problem. So failed settlements actually, not only the delays, but the fails are actually useful because if you're promising me those treasury securities and you're allowed to fail, you can promise them with some confidence because you're allowed to fail. If you go to jail when you fail, then you're not going to make the trades that you would have been able to make. So by having fail as an escape, you've expanded the virtual supply of treasury securities available to the market, and that's true for all securities transactions. So this trade-off between lowering counterparty risk, speeding a more efficient and speedy settlement system has a cost side to it. And that's a good, as I said, very good OR problem.
I would like to hear your thoughts on the widespread adoption of UPI, particularly what are your thoughts behind it, and how do you see that moving to a faster payment gateway, something like that?
Well, you probably know more about it than I do. I'm not familiar with the level of corruption, but I do know that with fast payment systems, you don't have the protection that the credit card companies offer, which is they'll be able to claw back the money or at least ensure the payment for you if it's not in every case, but in most cases. Whereas in Brazil, I know, because I haven't studied India, but I've studied Brazil, they have had some problems with fraud and getting the money back when a payment was instantly made when you say, the goods that I was just given are not good. There's something wrong with them. The sandwich is old or whatever, but the money's already gone. So it does introduce additional problems. And Brazilians have been working on that. They haven't got a complete solution yet, but they've mitigated it. What about India?
I think it has been a really faster process for me personally dealing with things, or let's say buying something, and it has been tentatively much slower over here. That is what I felt. But I think as you highlighted, there are bottlenecks to the issues. So happy to hear. Thanks.
Thank you. Yes, sir.
What do you think about meta universe coming in play regarding digital currencies future? Or should I say, it will be easier to find a common solution or common ground in the meta universe in the future?
Gosh, I never even thought about that aspect of the technology, but it is true that you could be a real consumer in a meta setting, and then you need to make a payment. I don't know how that would be done. I guess you could still do it, right? But I never thought about it. Maybe somebody else has already been working on that. I'm going to ask for a question over here.
So
will there ever be a successful stablecoin that's completely decentralized? Because currently all the successful stablecoins are centralized, and theoretically you can freeze the accounts on smart contracts, and all the decentralized algorithmic ones, they can all fail. But a decentralized economy might need a decentralized stablecoin.
Okay, so we should separate the algorithmic aspect of stablecoins from the decentralization aspect. Because you could, and I think you do have stablecoins that could be managed in a decentralized fashion on a blockchain. Now, in practice, most stablecoin payments are through an exchange, which is a centralized mechanism. But you do have the capability of transferring stablecoins in a decentralized way on a blockchain, most of them. And that separate issue is algorithmic stablecoins, which maintain their market value only through the hope and belief that they will continue to maintain their market value. They don't really have anything behind them other than temporary price pressure to keep them near the stable level. So, and that's why Terra collapsed last year. People lost confidence that it would maintain its peg. So I think you can have centralization or decentralization of stablecoins in terms of the payment system, but they're inherently built in order to have a decentralized possibility. Whereas all the other payment systems that I've discussed today, they don't have that possibility. You really have to rely on a trusted third party, like a bank or a central bank, to do most of the conventional types of payments that we've discussed.
Circle, like the issuer, could still freeze your smart contract address, even though it's running on Ethereum. Like a centralized entity could still freeze your account, freeze your wallet on a smart contract.
Does anybody else want to react to that? Because I'm not sufficiently familiar with what was just discussed. Clara?
I just want to say that there's no inherent reason for this not to be centralized. For now, like you can keep your dollars to the side, so there will be the dollars, but the control of who can move things. There's no inherent reason. But there's no inherent reason for the entity to control the transactions you're making. They don't even have to know what are the transactions that are happening. So there are cryptographic tools out there to allow you to move things
In a decentralized.
So the technology is there to
It's not required, yeah. And there's another comment in the back.
I was gonna say, well, as somebody who's run a centralized stablecoin, the problem you're gonna have is when you have an underlying pool of centralized securities, there's a lot of rules and regulations that attach to that. And if you can't freeze things on a blockchain for people's individual transactions, they'll just yoink the treasuries right out of your account if somebody's trying to interdict payments and break your peg. So what you're gonna find is anything that's a fiat-backed centralized stablecoin has to reflect that reality onto a blockchain. It's just an extension of reality. But like, to speak for one of my friends who's not here, which is Marco, he would tell you on the decentralized front, if you wanna have one of those that works, you need a very large and uncorrelated base of activity beneath it so that you actually have something in reference to the peg that people can have confidence in, and if you break that relationship, the peg will break. Right, so to get to true decentralization, you need a smaller thing on a much larger uncorrelated base.
Or they could be over-collateralized.
But with what?
My understanding of the technology is if you have, let's suppose, for example, you had a CBDC for reserves. So they're going to be literally always worth $1 no matter what. And now you could definitely build a decentralized stablecoin backed by a CBDC.
If you were allowed.
Oh, well, it's not against the rules. I mean, we don't have a CBDC yet, at least in this country.
Well, it's not against the rules yet.
Well, there are no laws or regulations. I mean, that's one of the things is regulatory uncertainty may be preventing entrepreneurs from investing in doing that because they're not sure what the regulations will be. So the faster that Congress gets the regulations done, or the legislation enabling the regulations done, the better off that entrepreneurs will be and the more likely they will invest in those sorts of technologies. Yes?
I want to hear about your thoughts on digital currency impacting inflation. Because, for example, fast payment gets everything go really fast, and when you think about P2P, there are multiple depositors and a lot of lenders, and that means that a lot of money is coming out from everywhere. So I guess there can be some kind of impact on inflation, and I want to hear about your opinion.
Yeah. So if you dial the clock back to pre-2008, before the financial crisis, the United States monetary policy rested in part on this issue of velocity of money, because the amount of currency and other funds in circulation and the speed with which they move around was used to control interest rates and inflation. However, since the financial crisis in the United States, there's a completely new approach to controlling inflation and interest rates that's been adopted by the central bank, which is to pay no attention to the speed with which money moves, but simply set the interest rate that's offered to banks. It was like the blue bar in that previous diagram. And then at whatever level the central bank wishes, and if inflation is too high, move the blue bar up, and if inflation is too low, move the blue bar down. That's basic. It's a much simpler approach. It does have other disadvantages, but some disadvantages, but it's no longer dependent on. So the introduction of a CBDC or a faster payment system, in principle, should have no impact on the ability of the central bank. Now, while it might seem that, oh yeah, then now consumers can move their money much faster, so maybe they'll want to buy stuff faster, or the Fed can just say, oh, well, today let's move it up another 25 basis points, and that will tamp that down. Yep.
I guess if there's like a successful or more successful fast payment infrastructure that allows transactions to be like 24/7 and more efficient, and also if a lot of people are accepting those payment options, would there still be a need for a CBDC to be built, and what sort of benefits would it provide? Because at least like tokenization of your current currency is like for benefits of speed, ensuring that settlement happens over time and having more use cases.
Yeah.
But if regular payment rails provides that, where do you think a CBDC would be an outlier?
Yeah, this is where I think the banks have a big head start, and good for them, that they can upgrade to a fast payment system and provide much, if not all, of the current benefits that a CBDC could provide. Now, that's not ruling out the possibility that a CBDC could do additional things in the future. But for now, I think you hit the nail on the head. A good fast payment system that's highly open and interoperable is going to look and feel and have the economics very similar to a CBDC.
And you said like in the future CBDCs could provide, what do you think are some areas where it could be explored?
Well, we just discussed one. If you wanted to have, let's say, other digital currency providers building on a base layer stablecoin that's rock solid, what could be better than a CBDC for that, assuming it's well built? And then maybe you could have an Internet of Things that, in which stablecoins and CBDCs could be used for many other futuristic applications that I haven't thought of that are based on smart contracting and other innovations. Agostino, thank you.
Yeah, in the interest of time, let us close out the session here, and thank you, Dario, again for a great talk.